And Mr. Rice, any trustee can act as chair? You're on mute.
Excuse me. Yes, without objection, the three trustees who are present can select an acting chair.
I vote for Mr. Kelly since I'll be talking for the next 3 hours.
Well, I would object, but let's go forward with the meeting. I won't. Mr. Jones,
Yes.
are you okay with that?
Yes, that's fine. Aye.
Okay. Good morning, everyone. We're here for the meeting of the Risk Mitigation Committee. Linda, will you start the meeting, please, by calling roll?
Yeah, yes, Carol will go ahead and start. Carol, can you?
No, it's Cindy. Go ahead, Cindy.
Okay, Cindy.
Okay, thank you. Good morning, trustees. This meeting is being conducted as a virtual meeting, so I will do a roll call of the trustees to confirm attendance. Mr. Knox,
Here.
Ms. Greenwood, Mr. Jones,
Here.
Mr. Kelly,
Here.
Ms. Sanchez. Staff participating in the meeting include Chief Investment Officer Jonathan Grable, Chief Executive Officer Santos Kryman, Chief Counsel Stephen Rice, Principal Investment Officer Bache Masarigian, Senior Investment Officer Chad Timko, Officers Robert Santos and Kwok Nguyen, Senior Investment Analyst Adam Cheng. Consultants participating in the meeting include James Walsh of Allborn, Stephen McCourt, Timothy Fila, Imran Zahid of Makita. Trustees, please use the Zoom chat option to be placed in the queue. At this time, we ask all meeting participants to mute their mics until you are ready to speak. Now we will proceed with the agenda.
Thank you very much. Linda, do we have any public comment?
We do not have any public comment.
Okay, thank you. Sorry, I skipped item 2. Approval of the minutes of the Special Credit and Risk Mitigation Committee of April 14th, 2021. Do I have a motion to approve?
Knox will move.
I will second that. Is there any discussion? Okay, Linda, roll call vote, please. I'm sorry, Carol, roll call vote, please.
Cindy. Sorry.
That's
Cindy,
okay.
roll call vote, please. Sorry.
Third time's a charm. Mr. Knox,
Aye.
Ms. Greenwood, Mr. Jones,
Aye.
Mr. Kelly,
Yes.
Ms. Sanchez. The motion passes unanimously with the trustees present.
Thank you very much. Okay,
Acting Chair Kelly, excuse me, point of
Yes.
order. We do need to take attendance for the board members who are present, as well as the committee members.
That's fine. Cindy, will you take attendance, please?
Yes. Mr. Santos?
Here.
Mr. Bernstein?
Here.
I don't see anyone else.
Mr. Green was on earlier.
Mr. Green?
Oh, he must have logged off.
Okay, and then you have Mr. Knox, myself,
1,
and
2, 3.
Mr. Jones.
And I see Ms. Sanchez as well.
Ms. Sanchez?
Okay, well,
Okay.
she's not responding.
Okay. And then Mr. Kelly,
Yes, I'm here.
Mr. Knox,
Yes.
Mr. Jones.
Yes.
Okay.
Thank you very much. Okay, let's move to the non-consent items. 4A, a recommendation by investment staff that the board approve risk reduction and mitigation structure review. There's a memo dated July 30th in your package. Bache?
Good morning, committee members and trustees. We've assembled a team of 6 people to present the structure review for the risk mitigation functional category. As you know, risk mitigation consists of 4 parts: investment grade bonds, hedge funds, cash, plus a new category, long-term US Treasury bonds, which was added in the most recent strategic asset allocation. All four components are designed to reduce the total portfolio's risk and to provide downside protection when the growth functional category encounters a downturn. Next page, please. Calvin is driving the slides, and I'd like to thank Calvin for doing that. So I'll begin with an overview, then we'll dive into each of the four segments. Robert will cover investment grade bonds. Adam will go over long-term treasuries. Chad and Kwok will present the hedge fund section, and John Kim will cover cash. Afterwards, I'll return to summarize. Now, you may note that at the end of the presentation, we've included two items in an appendix. One is a list of benchmarks, and the second is a glossary. Next page, please, Calvin. Now, this page may be familiar, as we used a similar version at the mid-cycle structure review last August. We highlight the role and objectives of the category, as well as its constituents. The recurring theme is risk reduction at the total fund level. Within the individual categories, it's worth highlighting that liquidity is the primary goal for cash, as liquidity is essential to paying the promised benefit. Investment grade bonds are a second source of liquidity. Their return comes mostly from income, and as a result, the investment grade bond portion exhibits low volatility. Long-term treasuries are more volatile, but they're intended to be hedged to equities. Hedge funds provide diversification by delivering exposures we don't have in other parts of the portfolio. And LACERA's hedge fund program has been designed to deliver low risk, good downside protection, and a high return to risk ratio. Next page, please. This page shows that although the four components share a common objective, that is risk mitigation, they achieve that objective in different ways. The entire continuum of strategies from passive or indexing to fully active is represented. The different parts of the portfolio are designed to take advantage of opportunities within their respective markets in a risk-controlled manner. For example, in the upper left, you see cash, investment-grade bonds, and long-term treasuries, which have clearly defined and easily investable benchmarks, so they're focused on delivering the beta of an index. In contrast, in the lower right corner, our hedge fund portfolio is designed to provide exposures that we don't have elsewhere in the portfolio, so we want very little beta to an established index. Instead, the focus is on generating return that's uncorrelated to other parts of the portfolio and is idiosyncratic in nature. Next page. Now, this page shows the inputs used in the strategic asset allocation a few months ago. It's no surprise that we expect the risk mitigation functional category to be the lowest return and lowest risk among the four functional categories. You'll see risk mitigation all by itself in the lower left corner of that chart. See the expected risk of under 5%, 4.6%. Next page, please. Now, this page is intended to confirm the validity of our strategic asset allocation assumptions. We see two reports from our risk provider, MSCI Barra. The top table shows that the risk reduction and mitigation category contributes only 0.6%, you see that circled in green, of the fund's total risk, and only 2.5% of the fund's active risk. The bottom table provides additional detail on those figures, showing that 90% of the category's total risk comes from investment-grade bonds, whereas 98% of the category's active risk comes from hedge funds. Bear in mind that we're talking about 90% or 98% of very small numbers. Also, it's to be expected that hedge funds account for most of the category's active risk, since the benchmark for hedge funds is T-bills plus 2.5%. This ties back to my earlier comment about generating idiosyncratic return. Now, I should point out that this analysis is as of May month end, so it doesn't yet reflect the addition of long treasuries because we haven't conducted that search yet. That'll increase the contribution to total risk by a small margin, but risk reduction and mitigation will continue to remain by far the smallest component of risk. Next page, please, Calvin. Now, this page is intended to place our structure review into the broader investment life cycle. It's a never-ending cycle. In May, we were at the upper right quadrant, having just completed the strategic asset allocation. Today, we're in the lower right doing the structure review. If the committee advances and the board approves the structure review, we'll continue in a clockwise direction towards implementation, followed by rebalancing. And in a couple of years, we'll be back to the upper right corner with another strategic asset allocation. Next page, please. Now, this page recaps some of the changes from the recent strategic asset allocation. We'll go into more detail in the individual sections, so I'll be brief. The pie chart on the left shows the new target allocations, and in the bright colors, we see the 4 risk mitigation categories, adding up to 19% of the total fund. Now, that's 19% in total in dollar terms, but as we saw earlier, less than 1% in risk terms. The table on the right shows the dollar amount of the rebalancing needed to transition from the previous targets to the new ones. As the column on the far right shows, we have to reduce risk mitigation by $1.1 billion. But that is a net number, so it understates the amount of activity. We have to reduce investment grade bonds by $6.3 billion, invest approximately $3.5 billion in the new long treasury category, and increase the hedge fund allocation by about $1.8 billion. In total, that's over $11 billion in rebalancing activity. Next page, please. This page provides further detail on the old and new strategic asset allocation targets, but in a slightly different format, so I'm not going to dwell on it. Next page, please. Now, although the focus of this presentation is structure, we wanted to include a page on performance. As you can see, the risk mitigation category outperformed its benchmark for the year ended June 30th. The same applies to investment grade bonds, which had a positive return, even though its benchmark had a negative return. And the diversified hedge fund program outperformed its benchmark by over 13%. At this point, I'll turn the presentation to Robert, who will go into detail on the investment grade bond portion of risk mitigation. Robert?
Thank you, Vache. So although Vache spoke to the role and objectives of each of the components of risk mitigation on slide 3, this slide is dedicated just to investment grade bonds. Investment grade bonds serves as a secondary source of liquidity to the total fund, with the objective of preserving capital in times when the equity market is down. The pie chart displays how much in percentage terms investment grade bonds make up of the total fund. We've highlighted here the 7% target allocation in blue. Next slide, please. Now, with the assistance of LACERA's risk analytics provider, MSCI, this slide compares the risk characteristics, sector weights, and credit quality of the investment grade bonds portfolio to its benchmark, the Bloomberg Barclays US Aggregate Bond Index. What's important to note here is that according to MSCI, the portfolio's tracking error, or active risk, which is the second line item in the upper left corner, is only 20 basis points. And most of this active risk is coming from interest rates and not from spreads or currencies or anything like that. The bottom line is that the portfolio only deviates slightly and is closely aligned to the benchmark. Next slide, please. Now, over the past 3 years, we've continued to refine the structure of the investment grade bonds portfolio to closely align it with the objectives of risk mitigation. We've included this background slide to show how the portfolio has changed, beginning with the increase in the portfolio's allocation to core and decrease in core plus fixed income strategies in 2019. A year and a half later, the board approved the defunding of the core plus strategies, where we further reduced the target allocation to 0 for core plus strategies with a range of 0 to 20%. We've since redeemed most of those balances and redeployed those dollars into the core index account. Now, as part of the structure review, the recommendation to terminate the 3 remaining core plus fixed income accounts becomes more of a housekeeping item. However, we would still require the board's approval. Now, as we shift to May of this year, the new strategic asset allocation reduced investment grade bonds from 19% to 7%. With this reduction, we're recommending that this component of the portfolio be separated into an allocation to passive or index strategies and active strategies. The next slide will go into that further.
Robert, I had a question on 13, on 12, slide
Yes.
12. Sorry, it was 13. How do you have non-investment grade debt in an investment grade portfolio? On the lower right, Moody's rating versus index,
Non-investment grade.
you have triple
no-
B and then non-rated,
Oh, non-rated.
and triple B.
Okay, so triple B is acceptable because triple B is investment grade. So
Oh,
anything
okay.
triple B and above is investment grade.
Got it.
The
Okay,
non-rated
non-rated?
component, I'm sorry,
Non-rated then?
those are just components of the index. Vachi, do you have I probably wouldn't even have the better answer for that one.
That's fine. You can get back
Yes,
to me.
sometimes the small issues are not rated. And some of our managers may want to purchase small issues.
Small issue by size?
Yes.
Okay, thank you.
So I think we're on slide 15, I believe, Calvin. Thank you. So once we've liquidated the balances of the 3 remaining core plus portfolios, the investment grade bonds composite will consist entirely of core fixed income strategies. Historically, LACERA's fixed income portfolio has not had a formal strategic allocation to passive and active strategies, but given the role that investment grade bonds plays within a functional asset category framework, we're now recommending target weights. Taking into consideration the role of investment grade bonds, the return, risk, fees, and liquidity, we're recommending that the investment grade bonds component have a 70% target allocation to passive strategies and 30% to active strategies. Now, this 70%, 30% split is in line with the passive active mix the portfolio currently has. Next slide, please. Slide 16 displays the investment grade bonds portfolio guidelines. As I mentioned earlier, the benchmark we compare this portfolio to is the Bloomberg Barclays US Aggregate Bond Index, which broadly tracks the US investment grade bond portfolio. As the slide shows, we expect the portfolio's tracking error to be no more than 50 basis points to the index. The index is not allowed to deviate from the sectors, countries, currency, and credit quality represented by the benchmark, and the use of leverage is prohibited. Next slide, please. This page displays how much of the investment grade bonds portfolio will need to be reduced to reach the new target weight for the risk mitigation category. Our calculations show that the new target weight established by the strategic asset allocation will require a reduction from its current weight of 15.8% to 7% of the total fund, or approximately $6.3 billion. Our plan will be to gradually phase in the reduction of the portfolio, contingent upon the board's approval of the benchmark changes that will be discussed at the Board of Investments meeting later this morning. Next slide, please, Calvin. Now, this is the last slide I'll be commenting on during our presentation. Here's what's in store for our team over the coming months. The biggest initiative will be to implement the reduction in the allocation to investment grade bonds. And as we're doing that, we'll continue to enhance the reporting of the portfolio, incorporating the MSCI Borrow Risk System, improve dialogue with our managers on ESG and climate risk, and heighten the reporting as it relates to the TIDE initiative. The bottom section of the slide lists the recommendations to terminate the core plus managers left on our roster and adopt a 70% passive, 30% active structure for investment grade bonds. I'll now hand over the presentation to Adam to speak to long treasuries.
Thanks, Rob. I'll briefly touch on the newest addition to the risk mitigation category, which is the long-term US Treasury bonds. In the spirit of risk mitigation, the role of long duration treasuries is to provide downside protection in equity market drawdowns. Treasuries don't have credit risk and should provide a source of liquidity in times of stress. For implementation, we are recommending a passive approach to gaining exposure in this efficient segment of the bond market. Next slide. As you recall, the new allocation target weight of 5% is 5%. We are looking to conduct a search for long treasury index strategies. The next step is to provide recommendation for minimum qualifications, which will be covered in the next agenda item. We expect to utilize a transition or overlay manager to gain exposure to treasuries while the long-term treasuries while we conduct the RFP. That's it. So I'll hand it over to Chad to cover hedge funds.
I have one quick question. Can you hear me?
Yes.
Oh, yes. Sorry, this morning was a technological challenge. Adam, one question about the long treasury exposure. Is the long treasury exposure simply meant to be sort of a filling out of our treasury exposure, or is it sort of meant to be some tactical play on the curve?
I don't think it's meant to be a tactical play on the curve. It's going to be benchmarked to the I think it's the Barclays Long Gov index, and simply just in the risk mitigation framework to offset equity growth risk to a certain extent. I mean, I think when
Right, right.
in the play on rates.
Although Barclays Ag really is more intermediate term bonds, and the long end of the curve is really falling a lot.
Yeah, no, I think it's the Barclays Long U.S. Government Bond Index.
Right. I'm not questioning the index that you've chosen for this mandate. I'm simply saying that sort of your total bond benchmark has more of an intermediate flavor than a long flavor. So it sort of feels like a departure from that kind of generalized idea of what benchmark risk is. I don't know. I just wondering why you chose long versus sort of an average Barclays Ag type intermediate exposure.
Yeah, no, I mean, I think my impression, I think is simply just to reduce the exposure to credit in terms of simply being U.S. Treasuries, and to have the exposure to long duration just in case, or in the event markets sell off and rates drop. It's just simply meant to be an offset.
Ms. Sanchez, if I can jump in here.
Yeah.
To answer your question, the allocation to long treasuries is not tactical. It is strategic. It was part of the strategic asset allocation exercise. And you may recall that Makita recommended the allocation to long treasuries as a hedge to the equity allocation. So it's part of the entire strategic asset allocation.
Got it. So it's meant to be a companion component as opposed to a standalone component.
A companion to the rest of the portfolio. Yes, exactly.
Got it. Okay. All right. Yeah, thank you. I did forget that.
Let's move on.
So if there are no other questions, I'll hand it to Chad.
Excellent. Thank you, Adam. And good morning to the committee members and trustees. Kwok and I will discuss LACERA's risk mitigating hedge funds portfolio, and we'll start here on slide 23. This page has our hedge fund honeycomb that outlines the objectives of our portfolio. As has been mentioned previously, we design a portfolio to deliver moderate returns that have low sensitivity to major markets such as equities. This return profile tends to be positive in most months, and it also tends to provide downside protection in months when the equities lose value. Page 24 on the next slide further frames the intentional design of our program. The red line plots different versions of hedge fund programs. Riskier and more directional programs would plot on the upper right of the red line. Tail hedging portfolios that are expected to offset losses in a market crisis, but also are expected to lose value in the long run, would plot in the lower left. LACERA's program is conservatively placed where return expectations are positive and both risk and correlation to directional portfolios is low. The takeaway from this slide is that our program is designed to be risk mitigating with positive returns over time. And Kwok will now provide additional information about our portfolio.
Thanks, Chad. Good morning, committee members and trustees. Slide 25 shows the evolution of the hedge funds program from 1.0 to 2.0 to where LACERA is today, 3.0. In 1.0, the program utilized hedge fund of funds providers to gain exposure to this asset category. In 2.0, we transitioned to a direct program and recalibrated the portfolio to be more risk mitigating, which the next slide touches on. We also launched an emerging manager program, which Chad will discuss in more detail later in the session. Now, as we look forward to 3.0, we aim to build out the portfolio towards its new strategic asset allocation target of 6% from the previous 4%. We'll continue to monitor and tailor the portfolio towards its program objectives and evolve the emerging manager program with the goal of future graduations. Next slide, please, Calvin. Slide 26 discusses the changes we've made over the past 2 years to get to the profile that we have today. A major change was updating the benchmark from cash plus 5% to cash plus 2.5%, which led to LACERA adding 5 managers that fit our profile and removing 2 that did not. Now we have a portfolio with characteristics that better fit the honeycomb objectives that Chad talked about on slide 23. For example, in March 2020, the average return from managers in our current portfolio lineup was negative 0.4% versus the global equity market index, which lost nearly 14%. Next slide, please. This slide shows the performance of our direct program over its history and recent time periods. As shown, the direct portfolio has outperformed its benchmark over the 1, 2, and 3-year periods. More importantly, though, is how it has outperformed. The table at the bottom demonstrates that the performance is in line with our portfolio's risk mitigating objectives, especially in the recent 1-year period with a strong Sharpe ratio, low beta to equity markets, low standard deviation, and shallow drawdowns. Next slide, please. Slide 28 shows our allocations across underlying hedge fund strategies and geographies. As you can see, it's well diversified across strategies and has a bias towards developed markets, which is intentional. The portfolio breadth across numerous strategies benefits the consistency of returns and a risk mitigation profile. Next slide, please, Calvin. This slide discusses the potential route towards reaching our new target allocation of 6%. As you can see, the potential future portfolio is more well-balanced across managers. Our plan is to increase allocations via rebalancing to well-performing managers that continue to fit our program objectives. What we have has been working and we're comfortable doing more of it. We will need board approval for other initiatives such as any new manager recommendations, or as Chad will discuss over the next few slides, proposed changes to the emerging manager program. And at this point, I'll hand it off to Chad.
Thank you, Kwok. And moving to slide 30, here we have some background information about our emerging manager program for hedge funds. The key takeaway is that the portfolio is currently being built after board approval in 2020. The initial investments, they have promising features, and we continue to operate with future graduations being the goal. Switching to slide 31, we are recommending an increase to the size of the emerging manager program. As the strategic target to hedge funds increase from 4% to 6%, we would like the emerging manager program to increase as well. Also, the program aligns well with several strategic initiatives for LACERA, as noted in the top half of the page. Casting a wide net and finding early stage partnerships that can grow into future graduations are important subcomponents. The bottom of the page has details about our recommendation. We recommend to adjust from a program that targets a dollar portfolio size to an allocation target of 15% with a 10 to 20% range. And using an allocation target with a range like this would allow the program to be more dynamic over time. Additionally, a larger program would allow LACERA's investments with these early stage firms to have a higher degree of impact. With the change, our average allocation could approximately increase from 30 to 75 million, for example. This larger investment amount can relatively more so help launch and establish institutional quality firms. Slide 32 shows portfolio guidelines for the hedge funds program. And most of these guidelines remain unchanged, and that's identified in the rightmost column. The fourth guideline down is new, It would cap exposure to non-developed markets to 30%. We discussed this topic with Allborn, and we're recommending this as a new guideline. Lastly, on slide 33, future initiatives are summarized. We heard Kwok describe our direct portfolio, and we'll continue to optimize it where we see opportunities. We'll be selective. And to achieve a new 6% target, as Kwok mentioned, we may rebalance upwards several existing investments that are in good standing. We also talked about continuing to grow our emerging manager program. With that, that concludes the hedge fund section, and I will pass it off to John Kim to discuss cash.
Thanks, Chad. Good morning, committee members and trustees. As expected, our cash portfolio plays a critical role and is the total fund's primary source of liquidity. It's the single source for paying our member benefits as well as funding any rebalancing activity. In support of our business continuity plan. And at the top right of the slide, we list the 3 primary vehicles we utilize to park cash. As a safeguard, we aim to maintain a 1% target allocation to ensure there are adequate reserves for benefit payments at all times. And some future initiatives for the cash program will be focused on enhancing operational effectiveness. And the objective here will be to move all cash movements through our primary cash account for improved visibility into monthly projections and cash flow activity. And with that, I'll now hand it over to Bache to discuss the team's next steps.
Thank you, John. This page recaps the salient points of the structure review as detailed by Robert, Adam, Chad, Kwok, and John. Within investment grade bonds, the most noteworthy recommendation is to formally adopt the 70-30 passive active mix. And as Robert mentioned, the Core Plus managers have already been defunded, so terminating them is mere housekeeping. Within long treasuries, the recommendation is to launch a manager search, and the minimum qualifications for that search will be presented in the next item on the committee's agenda. Within hedge funds, the goal is to increase the allocation to 6% of the total fund and to expand the emerging manager program to 15% of that 6%, equivalent to approximately $650 million. And for cash, which is the connecting link between all of LACERA's asset classes, we continue to enhance operational tools and procedures, as John mentioned, to continue delivering the promised benefit on time. Now, I'll conclude by saying that we've included support memos from our 2 consultants, both Makita and Allborn, for their respective parts, for their respective mandates, and that's included in the attachment to the memo. That concludes our presentation.
Okay, thank you, Bache, and the team for that presentation. I had one question. I don't see anyone else in the queue. Bache, I didn't quite get why you're comfortable with the target mix for investment grade bonds at 70-30. I get the relationship to the overall portfolio, but why not go 100% with passive for investment grade bonds?
Calvin, if we can go back to, let's see, which page was it? One moment, please. It was page 15. And as we say at the top, that recommendation, the 70-30, reflects our thinking on the trade-offs between return and risk, and fees and liquidity. Now, in bonds, as opposed to equities, active managers have demonstrated the ability to outperform. And so we wanted to leave a little bit of room for incremental return, but we felt if we do that in a risk-controlled manner by allocating 70% to the index, we'll have a good mix. There are lots of statistics, primarily because treasuries and mortgage-backed securities, which are, again, government-backed, represent over 70% of the index. So risk-controlled active managers, core managers with low tracking errors have demonstrated the consistent ability to outperform the index. So it was a trade-off between those two. That's why we didn't want to go 100% index.
Okay, outperformed by how much?
based on our tight risk controls, probably in the order of 50 basis points.
Okay. Okay, thank you very much. I appreciate that. I don't have anyone in the queue. So at this point, we would entertain a motion tied to the points on slide 37.
Knox, I'll move staff recommendation.
I'll second.
Ms. Sanchez will second. Thank you, Ms. Sanchez. Good to see you. Okay, can we take a roll call, please? Any discussion? Okay, none. Can we take a roll call vote, please?
Yes. Mr. Knox,
Aye.
Ms. Greenwood,
Aye.
Mr. Jones,
Aye.
Mr. Kelly,
Yes.
Ms. Sanchez.
Yes.
The motion passes unanimously.
Thank you very much, and thank you to the team again. Okay, moving on, the next item on our agenda is related to the minimum qualifications for a treasury, long treasury search. Mr. Bachi, are you taking this one again?
I'll take it, Mr. Kelly.
Adam will.
Okay. Adam?
As mentioned, before I'll be presenting the minimum qualifications for the long treasury search. Next slide, please, Calvin. So we're seeking your approval for the proposed minimum qualifications, evaluation criteria, and the scope of work for the long-term U.S. Treasury Bond Index Manager search. As a reminder, Makita has reviewed and concurred with staff's recommendation. Next slide. The evaluation team will be comprised of 3 members from the credit and risk mitigation team. Consistent with past RFPs, we plan to break up the search into 2 phases. First being the evaluation of written responses, and second being interviews. Scoring, evaluation review, and recommendation will be advanced to the Board of Investments for final decision. Next slide. The anticipated timeline is shown here. With the RFP launching in third quarter of this year, and the recommendation expected in Q2 of 2022. Next slide. Here are the recommended minimum qualifications. We are seeking registered firms in good standing with assets of at least 10 billion in bond index strategies and at least 5 billion in long-term U.S. Treasury bond index strategies. The manager should also have 5 years track record managing long-term treasuries.
I had 2 questions on this slide.
Yep.
The first question is, you in number 7, you're not defining an asset size, and I wondered why.
I think it's just to find managers that are institutional in nature and have the experience of managing pension assets with pension.
But they could be small pension plans, so you're not picking up that much of a incremental experience there. And then my other question was, maybe it's not on this page. You say you will present a finalist to the board, but the procurement policy allows you to present finalists. So I think I would recommend correcting that in case there is more than one.
Okay, will do.
Finalist. Those are my 2 questions.
Thank you. Calvin, can we go to the next slide? So here is our evaluation criteria. It's all pretty standard. With regard to an index manager, we'll primarily emphasize organization, trading, and fees. Next slide. And lastly, the scope of work. This involves the management of the long-term treasuries, as well as monitoring and reporting of the portfolio. The manager is also responsible for providing data and analytics to State Street and our risk provider, MSCI, to facilitate portfolio analysis, risk analysis. Also, as a partner, the manager will collaborate with the board and staff as needed. That concludes my remarks. So I would like to ask for your approval for the proposed minimum qualifications, evaluation criteria, and scope of work. Happy to answer any questions.
Thank you for that, Adam. Mr. Grable has a comment for us.
Good morning, Mr. Kelly, members of the committee, trustees. Just to provide context for the committee in terms of your deliberation with regard to advancing this, given that, and this goes back to Mr. Kelly's comment about why not 100% passive for investment grade bonds. This is a very efficient aspect of the bond market, and our expectation is that it's about scale, and with scale comes preferential terms as it relates to fees. So it's likely that the recommendation will be a single manager, but we understand the nuance behind Mr. Kelly's comment.
Thank you for that. Okay, so I see no other comments, no one else in the queue. I would entertain a motion to approve staff recommendation.
So moved.
Second.
Second.
Thank you very much. Cindy, can we have a roll call vote, please? Cindy?
Apologies, I was on mute.
Okay.
Mr. Knox,
Aye.
Ms. Greenwood,
Aye.
Mr. Jones,
Aye.
Mr. Kelly,
Yes.
Ms. Sanchez.
Yes.
The motion passes unanimously.
Thank you very much. We're moving on to section 5 of the agenda, items for staff review. I don't believe there are any.
No items for staff review.
Okay, great. Agenda item 6, good of the order. Let's see, anyone for good of the order? Okay, I would thank all of you. I feel like an understudy for today's performance, and I hope Hollywood calls tomorrow. With that, I would entertain a motion to adjourn.
So moved.
And Mr. Johnson, second. Thank you very
Second.
much.
Yep.
Have a great rest of the day. Thank you.